Hey guys, welcome back to Lifestyle Leads. It's Diem and
Hannah.
and today we are talking about our experience and maybe a little bit of info for you on how to get financially ready to buy your first home. We both have had different experiences buying our first home. So one of the questions that I get a lot because I talk about like how I had to figure out what to do with my debt was what should you do first? Do you pay down debt first, or should you be saving money for the down payment first?
Yeah, big question. That was also one of Kevin's and my question when we were looking to purchase our first home, and I think we came to some different conclusions here, possibly. So this is going to be really fun to talk about. So, Diem, why don't you tell us about your experience first? Because I think it's going to be really applicable to people.
Yeah.
So let's dive in. So, what was that like for you? What did you ultimately decide was the most important thing to do first?
Yeah.
Or did you do both at the same time?
So, some of you who have followed me know that part of my journey included starting up a business out of college, not really understanding how to run a business financially. And even though I graduated with a business degree, I actually didn't have real world implementation. So I trialed and errored and caught myself in a situation where I ended up filing for bankruptcy. And in that journey, I had to look up what to do after because and keep in mind, my debt was not discretionary debt. It wasn't from shopping or going out to eat. It was from trying to start a business and then managing that with some of what I had saved up and then credit cards.
Okay.
And so when I looked up first how to either pay down debt, negotiate debt, or file for bankruptcy, I also had to look a few steps ahead about what am I going to do after that to repair credit, to rebuild my life, and then ultimately build something of a net worth for myself down the road. So when I looked at either to pay off debt first or save for a down payment, it really had to be paying off debt first because there was no way, based on my research, that I could qualify on a debt to income basis to buy a house. And even if I started paying down those debts, the timing of how long it would take and versus like saving for a down payment, those things didn't line up.
Okay.
So for me, it was debt pay down simultaneous with learning how to budget.
Okay.
Because if you pay down debt, but you're still having spending
Totally
habits.
Yes.
And even though my debt came from the business, it wasn't from my spending habit. I still needed to be really strict in order to be able to pay a mortgage payment down the road.
Right. So then can I ask a couple questions about that?
Yeah.
So did you allocate your own funds to some of that debt payoff? Did you have to after the bankruptcy? Or did the bankruptcy clear pretty much everything? How did that work? Like, did you have to, be using some of those funds you would normally save to pay down that debt in addition to the bankruptcy?
Yeah, so I filed for bankruptcy at a slow turning point in my business. So I actually hadn't really been able to practice saving. What I was making coming in was enough to pay at the cleaners that worked for me at the time, and myself just to pay like rent. But there was no getting ahead. So this is kind of maybe starting a little bit premature. But that allowed me not to pay at least the minimum payments that were required on those credit cards. And then that could be allocated towards something.
Okay, so then the bankruptcy did pretty much clear everything for you.
Yeah.
And then what you were able to do at that point then was now take anything that you were making and start to save that.
Yeah.
Okay.
And the business started to grow incrementally.
Okay.
So as it did that, each new dollar that came in, I had to make a new decision. How does this get allocated?
Got it. Okay.
Also, something to note, the bankruptcy, why it eliminated all the debt is because I only had credit card debt. I didn't have back payments on a car payment. I didn't previously own a home. And so it was easier because it was unsecured debt is what credit card debt is called. It's not secured against an asset. So I was able to clear it with that bankruptcy.
Which was one of the reasons you decided that was the right plan for you, right? You felt like with the debt you had, that would be the best way to kind of get that clean slate, be able to start saving, and then be able to eventually purchase a home.
Yeah, and, to weigh out the cost benefit of that is, what does it do to your credit profile? How will you get credit to do other things like purchase a car or on a loan or lease a car? So there's a lot more to it. There's a lot of pros and cons to weigh out. Probably not the best solution for a lot of people, but in my particular circumstance with the business startup and that being the only debt I had and kind of approaching a slight turning point where the business was now starting to take off a little bit was kind of the perfect storm for me to make that decision.
So then in your journey at that time, you had to prioritize paying the debt off first and then be able to start saving.
Yeah.
Okay.
Yep. That was my journey. What about you?
So for myself, mine is a little different, which is why this is so fun to talk about.
Yeah.
Because I didn't have a lot of debt. I used credit cards for sure. And you'll hear me mentioning my husband because it was, our journeys together in this because we bought our first house. I was already married. And Diem's husband will come into this eventually with her other purchases as we talk about them.
Yeah, and that's an interesting piece too that we didn't think about and we can divulge a little bit later. It's like, what does it look like to purchase a home as a married person?
Yes.
Or as the only decision maker?
Totally, because it's so different.
Right.
It's such a different experience. We'll have to do an episode on that.
Yeah.
For sure.
Stay tuned.
But my experience, we had some credit cards, but it wasn't, we weren't living off of credit cards. So for us, it was more prioritizing on how to save. And we kind of went through this journey of saving for multiple things. Besides a home, we started, really trying to prioritize saving for retirement as well. So that was more our journey in debt payoff versus savings. Is for us, it was all about actually getting on a budget and not just using our money as it came in and using it for the things we wanted to do, that were all good and well and fun. We love travel, and that's something we've always prioritized. But then once we got on a budget, it was about, well, how do we budget for travel and budget for retirement and budget for saving for a house? So for us, the saving part really was the biggest part that we were prioritizing. Now, I do want to circle back to that a little bit because when we got to our second home, we were prioritizing both debt payoff and savings. And we can talk about that more later, but that is just an example quickly of how, maybe because your plan is one way once, right, in one situation, doesn't mean it might need to change going forward. So that's something we can talk about later. But some of the things that were really helpful for me when we were getting to that point of like, well, what do we want our future to look like, right? What do we want our future to look like? When do we want to try to make a home purchase? Do we even want that for ourselves in the near future? How do we save for retirement? All these things, we decided to prioritize saving, but the way we really learned how to do that was through a lot of different books. And we ended up, me specifically, I love reading about personal finance. And so I picked up a lot of different books. Yes, you do, of course. On budgeting and personal finance, and even to the point where it was like we were taking percentages, like very specific percentages, which if you're familiar with Dave Ramsey, that's kind of how he allocates things, but everyone is different, right? So reading a couple different books I think is very helpful because you get different perspectives on what people recommend. And there was a time where I literally, because of one of the books I read, and this felt like it fit my situation, set up a bunch of different savings accounts and had automatic transfers going into all those accounts for auto, for travel, for taxes, for saving for a down payment, and for all these different categories. I don't have that anymore because it's not what I need at this moment, but I felt like at that time, that's exactly what I needed. And it's important to know that just because you need something at one point doesn't mean you might do the same thing in the future.
Yeah.
So for me, the savings was definitely the piece that we wanted to focus on. But then also being more conscious about, okay, are we going to put this on a credit card or, will that affect our credit? And so definitely the savings, but I think debt was still very mindful.
One of the things that you should consider, because my situation of debt was like I eliminated all my debt through that process, right? But you may not be facing the same situation. And if you did have some debt, like credit card debt, a rollover balance, a few $1,000s, or a car payment, and you're thinking about, should I be allocating money to bring that balance down as low as possible? Or should I be putting my dollars to just the minimum payment or some other amount and then allocating it towards savings? That's where it's important to either do some research on your own about what debt to income is, or connect with a lender to learn what it needs to be to kind of like meet the price point in your market of what you can afford. Like if you're thinking I'm going to buy a 3-bedroom, 2-bathroom house, what is the average price point in my area, and what do I need in terms of a debt to income ratio to qualify for that? And the reason I say that is because it doesn't necessarily mean you should pay down all your debts to zero.
So true.
That dollar might be better allocated towards a down payment because your credit profile may already allow you to buy that home, but you don't have the down payment. So how could you possibly figure that out? You would talk to a professional.
Yes, and this is such a great topic, Diem, because it's such a great point, because that's exactly what happened in our situation. We paid down because we were used to not having debt, and because of what we believed at the time. We literally had no debt when we bought our first house, and we did not have to do that. We paid off our cars with cash that we could have used for other things. We paid everything off, including our car payments, before we bought the house. And, that was something I think that was our mindset at the time. And I wish we were more open-minded, because if we hadn't been so stuck on having to have no debt, we wouldn't have had to pay off those cars. Our credit profile would have allowed us to keep those payments. But because we were so stuck on that, our lender, didn't even have the space to be like, you don't have to do that, right? So it was just part of our process from the beginning.
You decided that on your own,
right,
before you connected with a lender.
Exactly. And so even during that process, though, even though we could have not have to do that, the lender didn't even tell us we didn't have to, because we had come to the position saying when we get into contract, before we sign, we're paying off our cars. And so with the loan documents that we signed, it had a paper saying that this balance would be paid off, because we had already decided that.
Yeah.
And to Diem's point, we didn't have to do that. And it's something that with my clients now, I always tell people, and this is a big question, do I pay this off? Do I pay this off? I'm like, don't pay anything off until we see your profile. And then we can make more informed decisions.
That's not to say that you should leave debt on your profile, but it's more about, if money was a tool, how would I best use that tool to get to the next step? And then kind of like having a plan, right? So if you're purchasing a home that is going to build equity over time, or in my case, like I bought a house and I house hacked. So actually the length of time that I own a home is more important, because someone else's rental income will be helping me pay down that. So the longer I own an asset, the better. So in this case, it would be okay for me to offset or compromise on leaving more debt if I had the option, versus getting into a home faster and having that debt pay down for the home start happening faster. However, there is plenty to be said about the peace of mind of knowing you have no other debt than going into a home with just the mortgage. And I think both things are fair, but you just need to know that going in so that you can make an
Yes.
educated decision.
And that's the thing. The more options, you have, the better.
Yeah.
And the more information you have to be able to make those decisions, the better. So I just feel like in my personal experience, it would have been more helpful, and in my future purchases, the one we just did, and my future ones, I know so much more now, but I wish that I had known that when I was going in at first. So if there's anything you're questioning about, it's always worth it to just go get a pre-approval, see what's going on,
Yeah. So one of the other things that I faced when buying the first home and thinking about finances and how to qualify is I was a self-employed person who I didn't know this until I came to the table and worked with a lender, starting to talk to someone. But what they told me I needed at the time was I needed the average income between my last two tax returns. And this was going on the third year after I had filed for the bankruptcy. I was able to use an FHA loan, which allowed me, with my credit profile, to go ahead and make that purchase. But my income wasn't enough to qualify for even the minimum price point that I needed for a single family home. And so I didn't realize that, because my last year's tax return was adequate. I did the math on that. And so I kind of learned the hard way that I needed the average of the last 2 years.
And with that being said, and it's still true, you do need the average of the last 2 years. The one area where you can kind of get away from that is if you've been self-employed for 5 years or more, and your most recent tax return, your profit looks higher than those previous years. We can use that most recent year, but only if you can prove you've been self-employed for 5 years or more. Usually, though, we have to use those 2 years. And even if you have been self-employed for 5 years or more, if your income has gone down in recent years, we still have to use the average. So you just, to be safe, plan on using the past 2 years of tax returns if you're self-employed.
Yeah. I started my business in June of 2011, and this was November of 2016. So I didn't have 5 years of tax records, And so for me, what I ended up doing was I got a co-signer, my sister and my brother-in-law, and we'll talk a little bit more about co-signers and credit qualifications in another episode.
Yeah.
But was kind of my journey on, qualifying, and income for qualifying was a lesson. But I also think about people who, what if you make cash tips? Or what if you kind of make money under the table and you don't put that on your tax returns? How would they qualify?
And this is really important to talk about because it does happen all the time. If that money is not reported, if you don't have a paper trail for that money that you can show to a lender, and it has to be specific paper trails. It can't just be like, oh, well, these are the invoices I got, but then it wasn't reported on your taxes. We can't use any of that income. And that can be a real hurdle when you're going to try to qualify to buy a house. So it's important that if this is something you're hoping to do in the near future and you're self-employed, or you're making money in different ways, I'd recommend just go talk to a lender as soon as you can to see what you might need to do. Because if you are self-employed, just the way the rules are right now, and we don't make these rules, but it's just how they are now, you have a lot more planning you have to do than if you're not self-employed. So it's just something to think about. And also something important, I think, to talk about when you're self-employed is, one of the perks is all the write-offs, right? But that can backfire on you a little bit when you're going to buy a house, because it can sometimes make your profit look so low. And when you're getting qualified, it does not go off of gross receipts. So again, go talk to a lender, find a way to have that income broken down for you so you understand what parts you're going to need to show in order to qualify for a house.
It obviously is a huge perk to be self-employed, to have a lot of write-offs. It's a lot of the reason why many of us choose that path. To be a 1099 or, to be able to have your own profit and loss statements. So subsequently, that means that you're actively choosing to pay more taxes in order to line yourself up to get a loan than if you didn't need to get that loan. Kind of is just the game that needs to be played. You need to demonstrate your ability to repay that loan based on the size of that loan amount.
Yeah.
And so it does cost some money to make some money. And whether that money is in a growing asset like, an owner-occupied home, or if you're the way that I did it, house hacking, and I still do that to today, it's an investment for me. And that's a sacrifice that you have to plan for and make, especially when you think about buying more than one home, because this journey needs to be revisited, house number 2, 3, and 4.
Right.
Yeah.
And, the other thing that can be really helpful is to talk to an accountant if you're self-employed. I mean, I highly recommend that. If you lay out the goals you have there, an accountant can also help you with understanding, okay, well, this is maybe what you want to show, maybe not what you want to show. And also, the nice thing is when you own a home, you get tax benefits.
Yeah.
And so, talk to the accountant about that too, right? Because maybe some of those things can offset each other.
So true. The first year the first 2 years, of planning for buying a home and getting yourself qualified, you might make some tax deduction sacrifices that you will regain later.
Yeah.
And then you'll just want to space those out, the first and second home purchase, in a way that you can still show the right amount of income for the next one.
Yeah. Yeah.
Okay, so let's talk about monetary gifts.
Yeah.
I will divert this to Hannah because I don't really know too much about this. I didn't get no monetary gifts. Okay.
I know.
Hannah, how does that work? Not just to say that Hannah does, but she knows in her line of work what that means.
We did not use gifts for qualifying purposes either. We did have some gifts after, which were so lovely, of our family. Thank you so much. And in qualifying, what's wonderful is you can use gifts from people, and it used to be just family members, and now it's loosened a little bit to where this person doesn't have to be a family member, but it has to be someone that you can prove is close to you, that you know them well. It can't be just a random person.
Yeah.
So that's, go ahead.
One of my questions about that is, why is this appealing? Like, I'm thinking, okay, well, first of all, it's hard to find somebody to give you money. How do you find that? But then second of all, like, is it because it's not getting questioned where that money's coming from? Or why is it appealing to have gifted money for a down payment?
So, very good question. With an FHA loan, the donor has to show 2 months of bank statements so that we can see where those funds are coming from. An FHA loan is provided by the Federal Housing Administration, right? So those are their regulations which are usually a little stricter, that you have to see 2 months of bank statements to prove where those funds are coming from. Because, you don't want to run into a situation where, of course, this is not most people's situation, but the regulations around it are so there's not like money laundering going on and all of these things that, could be illegal. And so with the FHA loan, you do have to show 2 months.
Right.
With a conventional loan, you actually do not have to show 2 months of statements if the money is wired directly to the escrow account. And that is just the way the regulations are now. If it's not wired and it's in the form of a check or anything like that, it still has to be paper trailed. So, and again, don't ask me why, but if it's wired when you're in the process of getting a loan, anytime you're wiring funds, there's less paper trail than if you're providing a check. And so just keep that in mind, that regardless, I always tell people that it's better to assume that money is going to have to be paper trailed than assume that it's not going to be. Now, in certain situations, it not having to be can be a benefit for sure, but it's always best to assume that it will need to be and make sure that the people gifting you that money know that. So then at some point, let's say we need that bank statement, there's not all of a sudden this $10,000 deposit, and now that $10,000 is being gifted to you. But we don't know where that originally came from. Right? So any large deposits like that have to be sourced. But gift funds are such a great way to increase that down payment for a first-time buyer. And most of my first-time buyers that I work with have gift funds. And they can be, from a $500 gift to a $200,000 gift, right? Anything helps. And it's usually just a lovely way that family members express their excitement and support for other people. And I have to tell you, from my experience, I've had experiences with first-time buyers who really thought a gift was not going to be possible from any family members. And then once they got into contract, family members came out being like, I want to give you a gift. So you never know during the process when that might be possible. And so it's always good to ask. And whenever I'm talking to any buyer, whether it's first time or second time, you can do it whether you're a first time buyer or not. It's always important to ask, even though it sounds strange going to your family and asking for money, but you never know how they might want to contribute to such, a big event in your life. And I've definitely had buyers who thought it was not possible and ended up getting significant gift funds from their family that really helped their situation.
And it could be that bridge, or, to bridge the gap. You're almost there. You almost have just enough, and that could be the case.
Absolutely.
And I'm sure that a gift is meant to be a gift legally, like not a loan or not to pay it back. But, I don't know, like...
I'm not going to go there.
Maybe you're going to be like, thanks for this gift. And then you just treat them really nice for a long time. Okay. So going on to using retirement funds to purchase a home. So I actually have experience with this. So when I was doing my research about, where to come up with money and how to buy my first home in this series of homes that I had planned to buy, I looked at Google and I said, hey, Google, what are my options? And Google told me that I could pull from my IRA up to $10,000. I don't know what the requirements are these days, so you'll have to look that up. But at the time, and I think that at least this part is still true, is that for your first time purchase of a home, you're able to pull out penalty-free up to $10,000. So I took $10,000 from my traditional IRA, and there is a requirement of within how many days from you withdrawing that and receiving that money to when you close. So I just saved that transaction until I was essentially like in escrow, and then I transferred the money, but I was able to prove to the lender that I had those funds available. And that really helped me out because I didn't lose the 10% that I would have been penalized. The drawback is obviously I don't have that money building, interest or growing inside of the investment account over time. But again, it's like swapping as a tool, right? Money as a tool, swapping that resource to point it in a different direction to utilize it for something else.
And that's a great point you brought up too about not pulling the funds until you were really ready. That's what we usually do with most of our clients is like, show us the retirement account funds so we know they're there.
Yeah.
But we're not going to start that process until we know you have an offer accepted, because we don't want, unnecessary penalties for whatever the regulations are at that time to be incurred. So that is something we usually wait for people to do. The other thing that's good to know is that if you have a 401k that's provided by an employer, most of the time you can borrow from that 401k up to $50,000 or 50% of your vested balance, whichever one is going to be lower. You can also pull funds directly from that usually, but you usually are also penalized and taxed on that. So to find out the specifics around that, the best thing to do is to talk to your HR department about how you could possibly borrow from those retirement funds that you have been saving there. And it's a great option. We have a lot of buyers who end up doing that. And like Diem was saying, it's taking money from one tool and using it for another investment tool. And maybe you have your money, building there and accruing interest and everything. And now when you're ready to buy a home, maybe you do pull it completely or you borrow from it and pay it back. And the nice thing about when you borrow from it is you're paying yourself back, which is really nice. But again, there are regulations around that. There's rules around it. So make sure you talk to your HR department about that if you're interested in borrowing or pulling from a 401k. But it's definitely something you can do most of the time. And it's really helpful.
When you borrow from your 401k, is that debt now counted against your debt to income ratio?
Great question. With a conventional loan, most of the time it is not. And again, I say most of the time because ultimately an underwriter is going to be making that final decision. With Fannie Mae and Freddie Mac guidelines, it should not have to be counted towards that debt to income ratio because you're essentially repaying yourself.
Yeah.
However, underwriters can be unpredictable, and if they feel like a credit profile is more risky, sometimes they might ask for things to be included that wouldn't otherwise. So every situation is different, but that's where if you're working with a good loan officer, hopefully they would go to bat for you and be like, hey, this is what the regulations say. Why do we have to do that?
Yeah.
If Fannie and Freddie are still going to be able to buy this loan at some point, because that's what happens to most loans, and that's why there's regulations so that when people are buying these loans, they know they're a certain standard. So if you have, a good team that you're working with, if there's something like that happens, hopefully they'd go to bat for you. So most of the time, it does not have to be included with a conventional.
Very good. That was helpful because I did not know that. If you guys are interested in what our personal first-time home buying journey looked like, stay tuned for the next episode. We'd love to share that with you. If you haven't already subscribed to the channel or like this video, please do so. And we're always looking for more content ideas in your questions down in the comments.
Yes. And I think that's it for today.
With that, we are signing off. Thanks so much, you guys. We'll see you next time. Bye.
Bye.